Good morning, everyone. Welcome to day 2 of the Israel Dealmakers Summit. I'm excited to be here. This is our 9th, our second in this location. We've had the Silicon Valley, we've had New York, we've had Israel. I've been part of 8 of them. I want to give kudos to our event staff here at Landmark and all of our partners. This is a really amazing group of people we brought together for this 2.5 or 3 days. So today and this morning, we're going to kind of move. Yesterday was a lot about innovation, autonomous driving and computing, AR, VR, the evolution of cybersecurity and behavioral analytics, all these things we've talked about. Today we're going to talk a little bit more around the deal-making side of what we are doing here. We've got a great panel, but just so you know who I am, I'm John Kunschner. I am a managing director at Landmark Ventures. Been with the firm for about 7.5 years. I focus on deal making within this tech ecosystem. I know a lot of you, hopefully meet more of you around M&A and investment situations. But before we dive into our first panel, I want to just give a few statistics to get our brains moving. If people will filter in just kind of where we are in the deal making landscape today. 2016 was an interesting year. I think it was actually the most active M&A year since 2000 from a deal perspective. And it had 96 deals over $1 billion. It had 7 VC-backed companies over $1 billion. But in the tech world, it was a little slower. Israel actually was kind of flatter down, considering you take a few big anomalies out. So it was kind of a mixed year in perspective. But it also had a lot of really cool, transformative transactions that I think are changing the way the whole ecosystem is positioned. If you look at Microsoft buying LinkedIn and doing it, why do they do that? It's all about the data. We just had a deal that happened, which is the largest deal out of Israel, which is Intel's deal buying Mobileye, which is a testament to what's going to happen around the driving experience in the future. I think things like Walmart buying a $3.3 billion private company, Jet, is an interesting dynamic of non-tech companies realizing they need to get into the tech game. And overall, if you look, 2016 was the first year where the top 5 companies were Apple, Google, Microsoft, Amazon, Facebook, the 5 largest companies, all tech. Not GE anymore, it's not Exxon. There's a new kind of guard being created, and I think right behind them are guys like Tencent and Alibaba. And so you have this kind of weird dynamic of the largest companies in the world are all very, very tech-centric, and they're very deal-centric. And so I think it's going to be an interesting 2017. This year we've seen some IPOs. 2016 was a terrible year. You saw MuleSoft come out. You saw Snap come out. I think that's a good thing for the general environment. We'll talk about a little bit of that. But in general, I think I'm excited to be here. I'd like now to call up our panel and kind of get things rolling. We got a really interesting group of people, so I think you're all here. Brian, you may be in the back. So first up, Brian Modoff is EVP Strategy M&A for Qualcomm. Come on up. We've got Arvind Purushotham, who's the MD and Global Head of Citi Ventures. And Jacob Lamm, who's EVP of Strategy and Corp Dev from CA Technologies. Welcome, everybody. Great. Well, thanks for joining us, everyone. Why don't we just start? We'll just go down the line. Quick introduction, kind of where you're from, what you do, and any other kind of quick intro comments you'd like to make, and then we'll get into kind of the Q&A.
Sure. You're looking at me. I guess we'll start with me. Jacob Lamm with CA Technologies. I run strategy and corporate development. CA is a $4.5 billion software company focusing on security, DevOps, and agile management around the world. We've done about $2 billion of acquisitions in the last couple of years in Europe, the US, and obviously some deals in Israel. We also do some venture investing tightly coupled with our internal incubation that's driven by our CTO organization. So my group invests mostly takes stakes in venture funds, and we treat the relevant properties within those funds as part of our overall accelerator business, and we tightly couple it with our internal. We have an interesting internal accelerator program, which is kind of an internal ventures that is driven by the CTO's office. So we kind of bring those programs together.
Great. All right.
Thanks for having us here. My name is Arvind Purushotham. I'm the global head of venture investing at Citi Ventures. Citi Ventures is Citi's innovation group, and a big part of what we do is invest in startup companies that could be impactful for Citi's business, and so in a sense, in and around financial services. So we invest in a bunch of areas. So obviously in what people think of as fintech, payments, saving, lending, wealth management, et cetera. But we also invest in security, which is a key part of our infrastructure and a key part of our focus as far as keeping cities safe, keeping cities' clients safe. We invest in data technologies, which include things like machine learning, artificial intelligence, and we also invest in customer experience technologies. So we've identified a bunch of areas that are changing rapidly in the outside world, where startups are innovating, and where we as Citi, which is going to be a more and more tech-heavy company, needs to focus on, right? So we bring those two together. We have about 8 venture investing professionals, 6 of us here in the Bay Area, 2 in New York, and we'll talk about a colleague that we've just started to work with in Israel. In the last 6.5 years, we've done about 45 deals, and a lot of our companies end up doing very impactful partnerships with Citi. Personal background, I've been running this team for a little while before coming here. I was a general partner at a firm called Menlo Ventures on Sand Hill Road. I was there for several years, and then prior to that, spent a number of years at Intel.
Good morning, everyone. I'm Brian Modoff, head of strategy, M&A, and ventures at Qualcomm. As you know, Qualcomm is the company that builds the chips that run your phones you're using right now. We're about 130 with NXP, about 135 billion dollar company. As you know, we're engaged in acquiring NXP for 46 billion. That is going to extend our reach with our SoCs and our communications systems expertise into automotive. Will be a very significant player in the automotive semiconductor market, obviously focusing on ADAS through level 5 as one of our key areas. IoT is another area. IoT really is you're essentially taking MCUs and sticking communications processors on them and putting them in all kinds of things. And one of the things we gain with NXP is access to over 30,000 different end market MCU customers that we're going to provide connectivity to and enable. So we're very excited about that. And then security is another area they play in, and that's a key underlying foundation for us along with connectivity. We do run an active venture fund. We spend about 150 million a year in ventures. Israel is a very important market to us. We've invested over 100 million in Israeli startups. We've been in Israel since 2009. Some key areas for us in Israel include radio, signal processing, security, and software. So it's a market that we really like to be involved in and find it to be very appealing. We'll actually be there with our own summit the 3rd week of June. So that some of you that are live in Israel might want to come over and say hi to us then. Thanks.
Great. Thanks, guys. I want to start out just maybe at a higher level as kind of how you plan out your strategies as deal makers. Obviously, the vast majority of tech deals are relatively small deals, $50 to $500 million deals. You're in the midst of a $47 billion, the largest ever in the semiconductor market. How do you balance between the objectives for deal making, which is obviously to drive shareholder value and growth and innovation, versus very large and very small deals, and how you can actually impact the organization? I don't know, maybe you want to start and just kind of the balance between those two dynamics.
Yeah, so it's a couple of things you look at. With regard to the larger deals, those are really for us to have a footprint in an area that we want to be involved in an adjacent area. It's important to us to involve ourselves in areas that we understand and can manage. So looking at XP, that is, IoT and automotive are adjacent to what we already do in mobility. So we use larger deals to really extend our reach and gain broader access to markets we want to penetrate. We look at the smaller deals really as tuck-ins to fill in gaps. There may be something, we've got a pretty complete portfolio in ADAS, as an example, but there may be certain areas that we feel we need to strengthen. And we'll use ventures kind of as forward scouts to really look into the future and get invested and engage in companies that are developing things that may be a few years from maturity. And we'll use M&A to acquire things that we need to have sooner that help strengthen our position. So that's kind of how we look at those two.
Yeah. Jacob, you have a different perspective?
Well, I mean, we think about it in three ways. I mean, it starts with our business units, our security group, our DevOps. They need to have a kind of 2 to 3 year strategy of where the market's going, what they need to do. And then from those capabilities, we say, well, what are we pretty confident we know how to build versus what's a little higher risk based on either skill sets or where the market's going. And based on that, we'll say, well, VCs, that's their business. They're into managing risk. We'll let them take the risk, and we'll pick a winner in 18 months from now. Mm-hmm. So it's really about product management maturity and having them think about, if there's I'm not saying we don't do deals other ways, but if there's oh my God, there's a hole in the portfolio, we have to fill it. Someone made a mistake, right? And so we don't want that to happen very often. So that's one perspective, and that's very, very strategically driven within a business unit, and we expect that to really be a longer-term play where we kind of know the company we want to buy for a really long time. The other one is really driven top-down, and that's the kind of the larger, let's get into another market, things we might not have expected a business unit product manager or general manager to kind of come up with, which says, okay, we want to expand our overall addressable market as a company, and we'll drive those deals top down. Those are typically much larger deals. And then on the other extreme, the venture investing, that's driven really via a kind of Horizon 3, how do we learn more? Obviously, we want a good return on the investment, but there are business model changes that we wouldn't try ourselves. We don't understand enough about. We want to learn. We want to kind of get an understanding of what's getting traction in the market. We want to get an understanding of the skill sets required. And we'll do, the venture investing, try to get ahead of that trend and try to understand more. So hopefully those are good investments, but also it informs our M&A decisions much better.
Yep. Okay. And Arvind, your question's a little different for you. Obviously, you're doing investing in companies, but Citigroup is an enormous beast of a company, and you've got to solve technology issues. I mean, looking at large investments, later stage companies versus early stage, just how do you balance that?
Yeah, it's a good question. I think the reason we exist is for strategic purposes. That's 100% of what we look for is that link to Citi and to financial services in general. And so, relative to my old job where I was a partner at a venture capital firm, we are actually quite flexible when it comes to stage, when it comes to the check size. We don't have ownership thresholds. Our goal is to find great companies and work with those companies irrespective of stage, as long as we find it very relevant to Citi's businesses and to financial services in general. And so we're very thematic driven. So, 4 or 5 years ago, we started to see the emergence of robo-advisors. They weren't called robo-advisors back then, but it was automated investing platforms. The idea being, how can you use software to make smart investing decisions, which may in fact turn out to be better decision makers than many human, financial advisors. And so, how do we think about that? So we started asking ourselves that question. We scanned the marketplace, and we came across a company called Betterment, and we decided to make an investment. I think this was nearly 4 years ago. And so in that sense, we are thematic driven, and this is also driven by the relationships we have with our business units. We talk to them about what's important, what are their priorities, what problems are they looking to solve, and use that as a way to scan the marketplace and identify great opportunities.
Yep. Kian, you kind of all said, listen, the business unit has to see a strategic value. I'm curious, you guys see a lot of deals, right? People are inundating you with opportunities. And I'm just, help me, people understand the process you go through of, as things bubble up, how long have you been working with these companies? What is the typical life cycle to get to a deal that really makes sense? And what are the 1 or 2 or 3 key factors that push it over the edge? And some of these things are very competitive. Some of them maybe are organically developed. Some of them come to you through bankers. What's the thought process that helps you prioritize all this noise you get from various deals that are out there? I don't know who anyone wants to start.
So I'll start. We have a pretty well-defined strategy. It never works out that way. Sure, we might have business priorities, but it depends on the quality of the assets, the negotiations that are ongoing. I mean, what we don't like to have is, the squeaky wheel kind of syndrome, and so we try not to base it on, those businesses that can articulate that are loudest and articulate the greatest need. But we have to weigh kind of the business priorities with the quality of the assets, with the ongoing negotiation that what's achievable, what's actually actionable in the time frame that we want it to happen.
Yep.
And based on that, that we end up with winners.
Okay. Have you a perspective, Brian?
Go ahead.
Yeah, so the answer to the question is, it varies a lot, right? So the way I think about it is, we're thematic driven, and a lot of it is driven by some of the relationships we have with the business units. We're an independent entity, meaning we don't need business unit sponsorship to make these deals happen, but we want to get our business partners along so that there is that, tight tie-in with the business and potentially a commercial engagement down the line. Having said that, the nice thing about the venture business is, some of the most disruptive things we never think about before they happen, right? You need to be, you need to have that funnel open and meet companies and evaluate companies. So it's a combination of what I think of as sort of top-down, thematic-driven approach, plus having that bottom-up, meeting companies out there that are getting started, that in areas that you never thought were interesting, but suddenly turn out to be very interesting from a financial services perspective and from a venture perspective. And so that's the nice thing about venture. And so we're able to react in both cases. Obviously, when we come across a company opportunistically, we still want to make sure that it's strategically relevant and sort of invest in those kinds of companies. And so sometimes we move very fast, and then sometimes it's a multi-quarter relationship with the company. Maybe we even start on a commercial thread with the company to drive towards a partnership before we invest. And so it goes both ways.
Okay.
So we tend to look at it a couple ways. On the M&A side, we actively monitor our space, and we look at things and relative to what the BUs need, and we pursue M&A as we see a need in a BU to fill a certain area. But we do look at things opportunistically from time to time, but with something that our team is actively monitoring. With regard to ventures, it's pretty specific. We want to invest in areas strategically important to Qualcomm. So we will look at companies that help us develop cheaper chips in the core. We'll look at companies that are involved in the core areas of our BUs, so automotive, IoT, security, mobility, software, kind of the core areas, AR, VR, and AI. And then we will look at end market companies. We will occasionally invest in end market companies. We do that to influence them, to get them to use our technology, and to give us feedback on how we can make that technology better. So like we've invested in robotics companies and drone companies. We'll never acquire any of those, but we do want to influence our end markets, and we'll use ventures as a way to do that.
Interesting. We're at the Israel Dealmakers Summit, so I have to ask a question. As you look at U.S. companies, European companies, and Israeli companies, one, is there a strategy for Israel specifically, or is it part of the technology ecosystem you're developing, and there's pros and cons you weigh in each kind of area that you focus on? If you want to start with that.
Well, we're in the security software market, sure. So we have to have a strategy for Israel, and to kind of, but the strategy is really to systemically kind of understand the market, look at what's coming out of the market. It's not really there is no strategy to let's acquire more companies in Israel.
Okay.
We do have a global strategy. We'd like to kind of, do more and more investment, venture investing and acquisition around the globe. So we've invested in, TLV, and I think some of those folks are here today in Israel. We'll probably be doing some more of that in Israel in venture funds, and we're doing that around the world. So there's a global investment strategy, but in terms of an acquisition perspective for Israel, no.
Oh, okay. Arvind, do you got a review?
Yeah, I think we're a global company, and so we're always interested in seeing how we could help not only our businesses but also geographies and get involved in ecosystems around the world. For the last few years, we've been mainly investing in North America, right, in the U.S., and then we started to engage more with our Israel team. I think Citi has over 250 people in total in Israel, in Tel Aviv, and over 100 people in our lab that's based in Tel Aviv. And so we started to work with them, I mentioned, early on, right? We invest in fintech, we invest in data, cybersecurity, and marketing and customer experience technologies. And so, when we sort of scanned the market, I mean, there was tremendous activity in Israel in these areas, right? Cybersecurity, can't overemphasize that, and obviously there's been a lot of activity there historically. But even in these other areas, we saw a lot of interesting activity, startup activity in Israel. And so that obviously was very attractive to us. The fact that we have deep connectivity there is important. Not only do we have relationships with a lot of the venture firms over there and entrepreneurs, we actually have people on the ground that can meet these startups, vet them, and then actually help with bringing them into Citi. So the idea is not to just invest and then sort of have that link be very tenuous. It's actually driving a strategic relationship, which I felt and we felt was possible with the size of the team we had in Israel and the quality of the team we had in Israel. So we started to get engaged, and so far we've done 2 investments. We just recruited somebody over there who will help us with new investments going forward, both sort of regular Citi Ventures, investments that we've been doing, but also go a little bit earlier and set up an incubator where we can make seed stage investments, a few seed stage investments every year. And so we're just in the process of kicking that off. And so I think it's going to be a really good geography for us for Citi Ventures.
That's great.
We tend to, obviously as we invest, a couple of things we consider. Obviously, we look at the teams. We look at their backgrounds. Have they done this before? Where do they come from? What gives them an edge in the area that they're looking at? And then on a regional basis, we tend to look at the strengths and weaknesses of each of the regions. And for example, we tend to look more in China, more end market companies investing in that, drone companies, robotics. There's a lot of work on end market products in China, so we want to leverage that strength. In India, we tend to look at software, particularly telecom software, but we want to leverage their strength in that. In Asia in general, we will look at companies developing cheaper ways of making chips, because they do a lot of fabrication over there. The U.S., we look at everything across the board relative to the core areas that I mentioned earlier. And in Israel, they've got certain expertise that comes from living in a bad neighborhood. They're really good at signal processing. They're really good at radio technologies. They're really good at security. And they're really good in software. So we will, again, it's our second largest market beyond the U.S. And we look at a lot of deals there. We like seeing Israeli companies and talking to them.
Yep. So you mentioned China. Interesting dynamic last year. I think there was a 70% increase of Chinese investment into Israel, which is a pretty dramatic figure, like $6.5 billion. There were about 16 deals done over $1 billion by Asian buyers.
Yep.
I'm just curious your view of, as these large Chinese companies become kind of part of your neighborhood more dramatically, how do you change your strategy at all, if you do? Or is it just kind of part of the equation?
No, we don't. I mean, we do our own work, and we will invest our money where we see it. Yes, there's always competition that could drive pricing up a little, but if it's of interest to us, we'll be involved in it.
Okay. Jacob, any?
Yeah, pretty much the same. It hasn't changed our strategy at all. We actually haven't, seen Chinese companies at least in our particular markets, right? In competing in our markets, they tend to be very, very driven by some large partners, and it's an area, maybe not yet. Maybe they'll get there, but they haven't really impacted our view yet.
Yep. Arvind, anything?
No, nothing much to add to that.
No? Okay, got it. Maybe to kind of flip many entrepreneurs in the audience in terms of, as you're going through process, as you're looking at deals, what are those factors that really push one company over the other in terms of either, is it pure product and tech, is it management, is it backgrounds? I'm just kind of curious, how do you rank some of the qualities of the entrepreneurial companies that come to you, as part of the deal-making process? Who wants to start?
Sure. I mean, the traditional things are always important, right? So obviously we're looking for track record, we're looking for, the references, and we're looking for good technology. I think what's different now is we're looking for unique teams, we're looking for business model shifts and changes and people who understand that. So when we look at a team, what I always discourage is don't present to us and kind of say, well, this is how we can help CA, or this is how we would fit into you guys. Because most of the time we're not looking to that. If you fit in, we don't really want you, right? We're looking to change our business model. We're looking to get into something that we didn't know or couldn't do. So it's a little bit of a shift from the way it was in the past, where we'd look for them to say, well, why should we do this? And really, I'm not saying need to be arrogant about it, but say, hey, we were able to achieve something that a large company maybe couldn't. Right, and here's what we do, and if we come into you, here's how we'll help you change. Mm-hmm. And I think if you can do that, we're really interested in that, because a lot of people can come in and they do things differently, and it's very kind of you versus them, yep. Right? Versus let me come in and help you change as a large company, and that's what we're looking for.
Arvind,
you? I'd say a couple things, right? First, we invest across stages, so we don't do very early seed stage deals for the most part. Most companies we invest in are post-product companies. But even in post-product companies, some of them have just gotten started selling their product into the market, and some are much further along, right? So if we're investors in companies like Tanium and Cylance, and we invested in them when they were much later on in their cycle, versus a company like Elusive Networks in Israel that we did in 2015, which was really their probably first or maybe second institutional round, right? So you look at these things, quite differently. A couple things worth saying, right? First is in financial services, especially, we see a lot of tech people getting into financial services. So especially in the early stages, we want to make sure that the entrepreneurs really understand the space that they're getting into, right? Especially in financial services, given regulation, given security concerns, and given the regulations that vary by geography, I think we want to make sure that people really understand the business that they want to disrupt, and that there is a clear business model that they can articulate, right? That's something that's super important to us. And then in the later stage companies, we look for product market fit and whether there's a repeatable sales cycle that can be demonstrated, and a nice ramp and a large market opportunity. So it just depends on the stage of the particular investment we're looking at. The relevance to Citi is a key important ingredient in all this, and sometimes, given our knowledge of Citi's businesses, we can actually come up with that. We identify that even before the entrepreneur identifies that, but we really want to make sure that both the entrepreneur as well as us know why Citi should be a part of this company, why Citi should be around the table, and I think that given the breadth and depth of our businesses, that as long as we are talking about the areas that I outlined, you usually can find a very interesting fit, but that is an important ingredient for us.
That's great. Okay.
So we, obviously the team is very important. The idea is also crucial to us. What are they trying to do? How advanced is it? How long will it take to mature? We will invest in seed round. We will do early stage. We only do late stage if we've been involved in the company from the early time. We won't come in late to a deal. We don't generally pursue that route. We generally either have a board seat or a monitoring seat at a minimum, depending on the size of the deal. And we do almost all direct investing. We don't do incubators and things like that. We tend to want to have direct involvement in a company, not through a third party.
Okay, thanks. The IPO market has reopened to some extent. I'm curious whether that changes any of the strategy, one around investing, timetables, or around M&A, as often companies have dual track, kind of views. It may push up prices, it may change. Any impact that a vibrant IPO market has on your strategies versus last year?
I mean, there's always an impact, usually not necessarily in changing the strategy, because we'll always plan for having lots of options. We have different business units, and as I mentioned earlier, there are different options, both small and large, and we're always running various scenarios in parallel, yep. Looking for the best outcome. I think for the companies themselves, it's always a little dangerous when it's just starting to change, because some of them and their boards might think their prospects are a little bit stronger than they really are. And I truly, many of them just kind of make mistakes, and it's quite unfortunate, especially for some of the principals. because given the opportunity to take lots of risk out and get a really, really good valuation. And again, it's not like valuations have dropped so tremendously since the IPO market has
No, it's actually
up.
pretty strong last year.
They're pretty strong, and so expecting them to go stronger because the IPO, our market might open up. And we're seeing an impact, yes. It hasn't impacted our strategy at all, though.
Okay. Good.
Yeah, I agree with that. I mean, it hasn't really impacted our strategy. I mean, I think overall, obviously, it's a very good thing. I just felt even through 2016, I mean, you were mentioning, John, that there was a dearth of IPOs, tech IPOs.
It's a good thing that it's closed, or it's a good thing that it's opening up?
It's a good thing that it's open now, because I think that there's a whole bunch of companies that actually were very, very good companies, lots of revenue, profitable or clear paths to profitability that were all staying private. So we saw the impact of that in other ways, right? There were lots of people who are public market investors who came into the private markets and they were able to contribute more money. Startups were able to raise more money, and so that meant that they were staying private even longer, right? So we saw some of that happen. I think it's a great thing that the market seems open. Some of these companies get out. The market.
You're a bank.
And markets, well, and a venture investor, right? So markets, will put a value on these things. So there is a justification for all the things that have happened in the 2013 to 2016 timeframe. So it's good.
Good.
No, given we're strategically focused, whether the market's closed or open really doesn't matter. We don't mind when it's open, that if it's an end market company we're never going to buy, they get out on that. That's nice because it gives us a good exit. So that we're encouraged. But other than that, it's really not an impact for us.
Okay. In our last 2 minutes, I guess I'll open it up to a little bit of forward thinking or trend spotting, or kind of how you view 2017. Any sort of words of wisdom or key strategies you think are going to develop over the next 12, 18 months? Anyone can start.
I'll just start real quickly. Listen, I think it's that people are there's so much technology trends and so many new things, so many hot things, that I think people are, from an M&A perspective, are going to miss the underlying business model changes that those technologies impact. And I think focusing on kind of what happens next in a particular market and how it really changes a business model is what's going to make these companies successful. And so when we look at, it's not just technologies we look at how it changes the way people buy something or market something, and that's the key. You saw it in SaaS. The companies that used SaaS just to create a new delivery model saw some really quick uptake, but unless they actually use SaaS to change the way people do what they're doing, the end result, they kind of slowed down and ended up being overtaken. We're going to see that in all these new technologies.
We think a lot about financial services, right? And within financial services, I think there are tremendously interesting areas that we continue to watch. Huge areas where we haven't seen technology come in. One area that we're focusing on, and I mean it's a very hyped up area, but in a way justifiably so, is machine learning. And I feel like machine learning is an area that can impact so many different aspects of financial services. And so we're going pretty deep in trying to understand how do we use some of those technologies to cut costs, improve productivity, increase revenues, leverage the data that we have, right? And that's something that's interesting to us. Second is another very large market that we're spending more time on is in real estate, both residential and commercial real estate. And how do we play a role there? Because online marketplaces are coming up. There's data available. There are people looking for investments. The interest rate environment continues to be, in a low interest rate environment. So that has turned out to be a very interesting area as well.
Great. Brian?
It's a very exciting time, actually, in our industry. The reason we're moving forward with NXP is we want to be involved in markets where they're emerging and we can influence them a lot. If you look at what's going on in autonomous vehicles and IoT, these are emerging early markets. And so we plan to be very involved in driving those markets forward, influencing their direction and participating. So we're very encouraged by what's coming. IoT is just emerging. There's a ton of experimentation going on. One thing you might want to go look at is go look at Lemnos Labs, to go in this incubator that we know that is sponsoring a variety of IoT startups. And there's everything from robotic arms, that are a company developing a robotic arm just to wash dishes in restaurants, to another company developing drones to fly up and attach themselves to the blades of wind turbines to clean them, because right now that's done by humans, and that's not a very safe job. So you've got this level of experimentation in IoT that's just coming out, and obviously we want to drive some of that with the MCUs and connectivity and security that we have in our combined company. And similarly with automotive, we're really in the early stages. We've got a ways to go to get to level 5 autonomous vehicles, and there's a lot of also experimentation there. Very actively involved in that. You know, things like security, AI, machine learning, all that will play an important role in what we're doing. But, you know, it's a very exciting time. You're going to see a lot of change in this market, and we're excited to be part of it.
Great. Well, thank you, panelists, everyone here. Interesting conversation. Good luck in this remainder of the year, and it sounds like we've got a lot of work to do.
Thank you.